Welcome everyone to today's Lunch and Learn webinar on lease accounting changes and their impact on commercial real estate. We are going to go for approximately 1 hour. It may be a little bit shorter. I know that the content has been provided and then it'll depend on your questions and the answers. These Lunch and Learns are meant to highlight member companies and issues as they arise. We're always looking for new ideas and content. In fact, this idea arose out of a meeting that we had with CLA and our board of directors. So let me know if you have ideas. So just like all Zoom webinars, attendees are muted and your video is disabled. If you'd like to ask a question, please type it in the chat. You can type it in the question and answer box. Only the speakers will be able to see it and me. And so when we're moderating the Q&A at the end, I'll be able to help move that through and get your questions answered. Our Lunch and Learn series is sponsored by Landmark Credit Union. We thank them for their support. Also, here is a graphic of all of our wonderful sponsors. Our partner sponsor is Ergens, our diamond level sponsor, Innovative Construction Solutions. And we have so many other great sponsors to thank. So please, when you're choosing to do business, support the sponsors of this organization. Just a little bit about events that are coming up. We have a big symposium coming up next week, what's really happening in office commercial real estate. A tremendous panel has been assembled. We're doing our prep call this afternoon. Then the week after that, CCIM SIOR is holding their golf outing. Madison Happy Hour, Old National Bank is hosting that in mid-June. And then we're doing a great event and panel, Market Insights of the Fox Valley, at the Timber Rattler Stadium in mid-July. And then, of course, the CARW golf outing on August 15th at the River Club of Mequon. We'll have lots of other events sprinkled throughout, but that's what you should mark your calendar for at the moment. Now, onto the program. Our presenters today, thank you so much. Scott Gokey, Director for CLA, and Renee Bernwerper, a principal at CLA. They'll be with us and they have a short presentation. And then again, we'll have time for question and answer. I'll turn it over to Scott.
All right, thank you, Tracy. I know that Renee is going to bring up the slides in a second, but we will touch base today on a new lease standard that takes effect, that affects all companies out there, essentially. And we'll also go over some tips and tricks on implementation. So it's actually called Accounting Standards Update 2016-02. So this was issued back in 2016. It's been around for several years, but is just now effective for companies. And it supersedes and replaces all prior lease accounting guidance that's out there. So it applies to all leases, including subleases. So you might see that pretty common in some industries where they might sublease out a portion of their space. But there is one exception to adopting this new standard, and that would be on short-term leases. So if you elect it and you have a short-term lease that is 12 months or less for the lessee, you do not have to adopt this new lease standard. You can essentially continue to expense the payments as you make them. So again, this affects all industries. You can go back, Renee. It does affect all industries out there. That includes real estate, manufacturing and distribution, not-for-profit, real estate and construction, airlines, everything out there. So if you have a lease that's greater than 12 months, your financial statements are going to be impacted. So why did the Financial Accounting Standards Board release this standard? They wanted a little bit more transparency and comparability as it relates to leasing transactions. So under the old standard, there was a little bit of play that you could do with the numbers, whether or not you expense the lease payments or if you had to capitalize the lease and put it on your financial statements. But now it's a lot more black and white. There's not really any ability to manipulate those transactions. So now we're going to be seeing almost all leases going to be reported on the balance sheet. So what you're going to see, and we'll go over this a little bit later on going forward, is a right of use asset on the financial statements. And then on the liability side, it's going to be those present value of the future minimum lease payments. So under old accounting guidance, you would just disclose that, hey, you've got a lease, a 5-year lease for your facility, and I'm paying, $5,000 a month for the next 5 years. Well, now you're actually going to have to record that on your balance sheet, that future minimum lease payment liability. And then again, you're also going to have a right of use asset. The good news is if you're a lessor and the owner of the real estate, the accounting will remain largely unchanged. So really, this affects lessees a lot more than it does lessors. So you can advance the slide, Renee. So again, it does apply to all leases that are greater than 12 months, but it doesn't apply to certain types of leasing arrangements, such as leases of intangible assets, which would include software, if you've got minerals, oil and gas, or timber and stuff like that. So again, it applies to all real estate leases. If you've got a company that leases machinery and equipment, whether that's forklifts, copiers, CNC machines, if you lease any automobiles, if you're Southwest Airlines and lease your planes from Boeing, it would apply to that as well. So when is the effective date? Now. It takes effect right now. It started essentially with your January of 2022 financial statements. So really for our calendar year clients, it's going to be effective for their 12/31 2022 financial statements. It has been deferred several times for privately held businesses and not-for-profits to 2022, but it has been in effect for SEC or publicly traded companies out there. So if you're Walmart or Walgreens or Johnson Controls or what have you, you've had to adopt this standard for several years. I know a couple of years ago, I was actually listening to a roundtable from the FASB, and they had the gentleman on from Walmart who was in charge of Walmart's leases. I believe that they had somewhere between 10 to 15,000 different leases that they had to account for. So that's why they have a person who oversees, that's all that they do, all their various leases. So how will this impact your organization? It's really going to affect your financial statements. Your balance sheet and income statement is going to look a little bit different, but more likely than not, you probably have a loan from your bank. Most companies do. And included in that loan from the bank are typically covenants and conditions that companies have to maintain. So this definitely could impact some of those financial ratios that you have with your bank. So I would encourage if you're on a board or maybe you own a company to make sure you review those covenants with your banker, both the before and after under the old accounting guidance as well as the new accounting guidance to see if this will impact your compliance, because you don't want to wait until after you're not in compliance to talk about it with your banker. So how do you get there to implement this new standard? We've probably all heard the saying, a goal without a plan is just a wish. So just wishing that it's going to happen isn't, going to help. So I would encourage you to, just have a process. If you're a smaller company, maybe only 1 or 2 leases, it should be fairly simple. But if you're a larger company, maybe you've got 10, 15, 20 leases for a variety of items, whether it's your real estate or machinery and equipment, it'll definitely take some time. It's hard to say how much time each lease will take, but it definitely will take some time. And again, if you've only got a couple of leases, you might be able to get by with Excel to help out with your debits and credits and disclosures. But if you have more than, just a couple of leases, I would encourage you to, purchase some software that'll help you out through all the disclosures and the accounting entries, or, seek help from your accounting firm, such as CLA, for example. We've got tools and resources that can assist. So what is a lease? So on the screen, we've got the definition. There's 2 main items there. So it's definitely a contract that conveys the right to control the use of an asset. So it has to be an identified asset for a period of time in exchange for consideration. So money has to be exchanged. So the 2 main items are you need an identified asset and then the right to control that asset. And again, you might sign a lot of documents, and just because it says lease at the top may not mean that it is actually a lease under financial accounting standards boards. So you might want to look a little bit deeper before assuming it is a lease. And then also, we talk about it a little bit on the screen, but you might have something out there called an embedded lease. So that's a lease within some sort of other lease or service agreement. Just some very basic examples of that might be, you may have heard of it, although it's not significant, I agree with you, but you might be leasing your coffee service at $200 a month for someone to provide you with coffee. And then what do you also get for it? Chances are you have a coffee making machine in your break room. So that would be an embedded lease, although it may not say lease on it. It might be a service contract with the coffee company. It actually would have to be accounted for under this standard. Again, taking materiality into consideration. Or maybe you've got some data in a server off-site that you essentially control, but it needs to be off-site, maybe for HIPAA purposes or what have you. So you need a separate server. So although it's not on your premise, you might have it in the cloud, for example. That potentially could also be an embedded lease. Another place to start is your prior year financial statements. That might list out, that's a good starting point at least, for all the various leases that you have for your equipment and facilities. So is it a lease? Well, you need, again, that identified asset and the right to control the use of the asset. And under the identified asset, it has to be either explicitly or implicitly specified. So explicitly would mean, you're leasing, 2022, Tesla, VIN number, whatever. And implicitly is maybe something from the supplier, for example. Really, it's the only asset that you use from them. So chances are that's the asset that you're leasing from your vendor or supplier. And then you need that right to control the use of the asset during the lease term. So you need to have the decision-making authority over that asset. And also you have to receive substantially all the economic benefits from the use of that asset. So if both an identified asset and the right to control the asset during the lease term are not present, then it's not a lease, it's simply a contract. And therefore, this lease accounting guidance would not apply. And then we do have a screen on here about substantive substitution rights, but just for the identified asset. But in the interest of time and not to get too granular, I will skip over that slide. But under the right to control, we had talked about the decision-making rights that you need as the lessee. So for example, if you lease a vehicle, I would hope, but chances are you have the right to control that vehicle, when to drive it, where to drive it, et cetera, et cetera. So if that is the case, you do have the decision-making authority under the right to control the use of the asset. Therefore, as the lessee, you control it. And then with that, I will turn it over to Renee.
Thanks, Scott. So now that we've talked a little bit about identifying leases, I'm going to take it a step further and move into the lease terms and consideration. The first topic under lease measurement is really to separate out the different components of the contract. Non-lease components of a contract are really only those items or activities that transfer goods or services to the lessee, such as CAM. Items that are not components of the contract would include administrative tasks or reimbursement or payment of the lessor's costs, since they don't actually provide a transfer of goods or services for the right of use asset. And once you've identified the different components of that contract or lease, the consideration should be allocated to each separate lease component and non-lease component of the contract. It's important to note, though, that there is a practical expedient where you don't need to separate out the non-lease components, and you can combine it as a part of the measuring of the right of use asset and liability as an accounting policy election. And while this will save some time and energy and it will be easier to calculate, the flip side is to keep in mind that it will also create a higher value of right of use asset and also a higher liability, which may be something that you'll want to kind of keep an eye on. The second topic is really the lease measurement, and that's to determine the lease term and the consideration or lease payments in the contract. The calculation for each includes the items noted on the slide, and in relation to the lease term, and will require the use of judgment to determine. One thing to note is that under 842, a lease will create enforceable rights and obligations. So the lessee will need to determine the lease term based upon the period of time in which they are reasonably certain they're not going to terminate the lease. So in all periods in which they are reasonably certain not to terminate and there are enforceable rights and obligations, those would be considered parts of the lease term. But keep in mind that an arrangement is not going to be enforceable if both the lessee and the lessor each would have the right to terminate the lease without permission from the other party and with no more than an insignificant penalty. So those portions of the lease term would not be considered part of the lease term when you're looking at your right of use asset and your total liability. And then also, just in determining this lease term, you should really also consider your prior experience with renewals and terminations, as well as any economic incentives for executing these, such as whether or not there's some significant leaseholds or maybe some other market conditions that might make it more favorable to continue to renew that lease. And as it relates to the consideration exchanged, this should include the normal lease payments plus any fixed payments or variable payments that are dependent on the rate or an index. And then it would be reduced by any incentive paid or to the lessee. So what discount rate would you use? Well, once you determine the lease term and considerations, you'll have to apply a discount to determine the present value of the liability. The entity should really use the interest rate implicit in the lease as a discount rate to determine its lease liability, if that information is readily available. Oftentimes, however, it's not going to be, the lessee isn't going to have access to that information. And so it might be easier to use an incremental borrowing rate to determine what that present value of the lease liability might be. Here again, 842 does provide a practical expedient for non-business or non-public business entities to elect as an accounting policy to use a risk-free discount rate, which is tied to the Treasury, using a comparable period with the lease term. The one item to note here is that this discount rate, it can be material to your financial statements over a period of time. So it's important to remember that the higher the discount rate, the lower the liability will be, whereas the lower the discount rate, the higher the lease liability will be. So that'll be an important consideration as well. We aren't going to go through a lot of the calculations, but this is kind of a high-level illustration to show what's really driving the calculation of both the lease liability as well as the right of use asset. So as you can see here, we assumed a lease term of 5 years and a discount rate of 5% to really get to what our lease liability will be. And then in order to get to our right of use asset over here, we're going to add on any initial direct cost that lessee incurred in order to obtain that lease, but then also subtract out any kind of lease incentives that they may have received in that process. So that's where your right of use asset's going to come in, and you can see that they are not the same amount. Moving on to just classification of operating and finance leases. Here's a table that kind of shows some of the summary accounting and presentation for each of the financial statements. Under the new standard, capital leases are now actually going to be called finance leases, and there's no change in terminology as it relates to operating leases. As you can see, there is some similar initial balance sheet impact for both presentation and disclosure, but you do not need to separate out you do need to separate out the operating and financing leases. For the income statement, you are going to have a little bit different presentation. For the financing leases, you're going to have an amortization and an interest component to your expense, while as on the operating lease, you're really just going to have your cash paid for your lease payments. And the cash flow statements also has a different presentation. So for the operating leases, all of the cash paid out is really going to be considered an cash flows from operating. While as if you have a financing lease, you're going to have any kind of principal payments that are actually reducing your lease liability on a monthly basis. Those are going to show up under that financing section for your cash flow statement. So here's a summary of the impact to the income statement. As we noted on the prior screen, you will have a straight line lease expense for operating leases, and then the finance lease is going to have your amortization expense for the right of use asset and also the interest expense for the finance lease liability. So then the result of this is really that with a financing lease, you're going to have some front-loaded expenses. So you're going to see a greater P&L impact with a financing lease versus an operating lease at the beginning. So now that we know the importance of proper classification between operating and finance leases because of the different presentation, let's look at the 5 criteria that would indicate that you have a finance lease. You would have a finance lease if any of the following 5 criteria is met. You have a transfer of ownership, there's an option to purchase and it's reasonably certain, there's a lease term and it's a major part of the economic life of the asset, the present value of the lease payments is substantially all of the fair value of the underlying asset, or which is new with 842, the underlying asset is of a specialized nature. So if none of the above are met, then you would have an operating lease. But otherwise, if one of these is met, then you would consider it a financing lease and have to follow that accounting. Transfer of ownership is met in situations where the lessee is required to pay a nominal amount in connection with the transfer of ownership. However, it's not going to be met if there's a provision that the transfer of the underlying asset is not transferred if the lessee elects not to pay the specified fee to complete the option. So that would be considered an option to purchase rather than an actual transfer of ownership. Couple ways to kind of determine whether or not you have a major part. The lease term is a major part of the economic life. If it's 75% or more of the remaining economic life of the underlying asset, that lease would be considered a major part of the remaining economic life and would satisfy that that criteria that it's a financing lease. Also, if there's a commencement date that falls at or near the end of the economic useful life of the underlying asset, if it refers to a commencement date that falls within that last 25% of the total economic life of the underlying asset, there again, that would be substantially all. And then 90% or more of the fair value of the underlying asset amounts to substantially all of the fair value of the asset. So a little bit additional information on criteria used to determine whether or not it's financing lease. Just going to walk through a quick example here. As you recall from earlier, a right of use asset initial measurements include the measurement of the lease liability, any lease payments that were made to the lessor at or before the commencement date, minus any lease incentives that were received by the lessee, and any initial direct costs that were incurred by the lessee. So I'm going to walk through 2 examples where we kind of assume that none of those actually took place. There was no direct cost paid and no lease incentives received, just for comparative purposes. So for this first example, we have an operating lease with a 3-year term, annual rents of $100 escalating at $3 annually, using a 7% discount interest rate. So based upon these factors, the lease liability in this case and the right of use asset both have an initial value of $270. And at initial recognition, we would record the right of use asset and lease liability at the $270. And then we have a chart on the side here so that you can see the calculation of the components for each year. You'll notice that in column A, that the expense is straight line over all 3 years, even though the payment in itself in column B is actually increasing by that $3 a year. And although interest expense is not recorded, remember only the expense is one single line item for lease expense for an operating lease. We show the other components here that you can kind of see what's making that up. Same with the amortization of the right of use asset is actually increasing here, but the only P&L effect is really going to be this total expense here. Then with a finance lease, let's walk through the same example, the same set of terms. So 3-year lease, $100, $3 a year increase at 7%. Note your initial recognition is still, it's the same here because there was no additional cost paid, and there were no lease. The lessee received no kind of incentives. So we still have a right of use asset and a lease liability of the $270. However, you can see that in the table, the amortization of the right of use asset in column A is now a straight line rather than the increasing that it was here in the operating lease. And then you will see that the interest is actually higher in the first year, and then it decreases. So as we mentioned earlier, in a financing lease, your expense is going to be front loaded. So your expenses are going to be greater in the beginning, lower in the end. You can kind of see that coming through here in this example. So as it relates to lessor accounting under the new standards, it's largely unchanged with the main updates related to glossary terms to be consistent with lessee accounting. And you can see here that there will be a similar treatment for sales type and direct financing leases, at least from an overall accounting model standpoint when compared to operating leases. And on the balance sheet, you will have the net investment in the lease is going to be equal to your lease receivable plus any unguaranteed residual, plus your deferred profit. And on the income statement, you will have an income statement that's front-loaded for sales and direct financing, similar to the finance lease for the lessee. And then the cash flow is the same for all 3 types. It's all going to be cash received for lease payments on the lessor side. Since we're in the year of adoption, it's important to be aware of the transition methods available upon implementation. There are 2 options. The first would require more time and effort to show the impact for both years as a comparative presentation, whereas the second would be less time consuming, but it would not show apples to apples. It would be in the current year, you would show the lease adoption, and the prior year, you do have the option of just showing the presentation as it was previously under GAAP before implementing 842. So as you begin to implement, here's a few additional considerations. There are a number of practical expedients and some accounting policy elections to be made. Many of the elections will save time, but could end up increasing or decreasing the liabilities recorded. So there's also an opportunity to apply professional judgment to a number of areas, such as the lease term, renewal options, fair value, remaining useful life, which will all impact both the classification as well as the amount of right of use asset and the lease liability that will be recognized. So now we'll move on to disclosures. As discussed, the motivation behind the new standard was really to assist in the transparency of lease arrangements. FASB wanted to be able to enable users of the financials to assess the amount, timing, and uncertainty of cash flows that arise from leases. The disclosures previously required weren't providing enough information, so both qualitative and quantitative disclosures have been enhanced with the new standard. Here's a table that shows what the existing disclosures were compared to how they're being enhanced now under 842. Note that we now need to include information about leases that create significant rights and obligations for the lessee. Information regarding practical expedients that were adopted need to also be disclosed, as well as assumptions and the judgments that were made. This list is not meant to be all inclusive, but just kind of gives you an idea additional disclosures that are going to be required. As noted earlier, many aspects of the lease standard involve significant judgment. The lessee must now disclose significant judgments as well in the financial statements, such as the determination of the discount rate, how they allocated between lease and non-lease components, as well as any short-term lease exemptions. And here we've just included another table that shows the existing lease disclosures under 840 and the new requirements after adoption for the quantitative portion of the disclosures. Again, not a complete list, but just kind of give you an example of other things to consider. And with that, Scott, I'll turn it back to you.
Yeah, I just wanted to talk briefly about one lease nuance specific to not-for-profits. Maybe you're on a not-for-profit board or what have you, but typically a lot of not-for-profits may be able to negotiate either free rent or reduced rent in their leases that they have. So again, as I had mentioned earlier before, in the definition of a lease, it includes for consideration. So is donated rent a consideration? And the answer is no. So you have to have consideration for it to be a lease. So on the next slide, we talk about, okay, what do you do when you've either got free or donated rent or below market or reduced rent? So if you've got entirely 100% donated rent, it's not a lease. So there is no lease to record there. It's entirely a gift in kind, they call it. So you'll debit the rent expense and credit contribution income. So there's no net effect on your net income or change in net assets. However, if you're only receiving a reduced or below market rent, you'll actually have two components. You will have a lease, and that portion relates to the amount that you pay per month. And then you will also have a donation or a gift in kind for the below market rent. So for example, let's say that the fair market value of the space is $5,000 a month, but you're only paying, let's say, $1,000. That $1,000 is what you would use to calculate your right of use asset and the lease liability, because that's what you're actually paying as the tenant. And then that below market rent, or $4,000 for reduced rent, would factor into your gift in kind or donation that gets recognized on the financial statements. So again, this is just specific to not-for-profit entities. So there's a little bit of nuance there.
So then let's just talk briefly about implementation tips and strategies. As with any project, the more time spent on planning and preparation, the better execution is going to be. So while the process may seem simple enough, in practice, most entities that have adopted the new standard have underestimated the time, complexity, and cost in adoption. So the first step is really to ask tough and probing questions to understand potentially hidden complexities and implementation challenges. Entities that seemingly have minimal leases or complexities may be unexpectedly impacted. Why? Because leases exist in an array of different forms and formats and may not be obvious or easily identified, as Scott pointed out, with embedded leases and things. This is in fact likely the most time-consuming and complex process or part of this process of the lease implementation. So how long will it take? It depends, but plan for months, not weeks. Three of the most common factors affecting the timeline and effort will be the size and complexity of your leasing portfolio, how structured and available your leasing arrangements and data is. Do you have access to all the information you need? And the availability of your internal resources to actually work through the process and identify the leases and everything that needs to be considered. So consider this when you're developing your implementation and assessment plans. And as always, plan for the unexpected and delays. So to start the process, we'd encourage you to make an inventory of all your leases, and then start going through them. Does it meet the definition of a lease? Are there embedded leases that we need to identify and look at closer? Then take it one step further and determine, do you have operating or financing leases? Do they meet any of those 5 criteria that would make it a financing lease? And finally, identify your key terms, your discount rate, your initial direct costs, and then document what you're using and why, so that you have that information there when you're ready to put together your footnotes or your disclosures. So why start now? As we stated earlier, expect the unexpected. Reviewing your leases now can help you identify potential problems, whether it relates to debt covenants or changes in process, accounting entries that will need to be made, or possible rewriting of leases. Does it make sense to convert portions of a lease payment to be contingent on certain circumstances rather than have it be a fixed payment? Should you consider revising the term of your lease, or can a lease be better structured to change your impact on your balance sheet and your financial ratios? Does it make sense to adopt an accounting policy to apply one of the practical expedients? Once you've gathered all this information, your organization is going to be able to make a much more informed decision about how to proceed with your lease implementation, and then avoid surprises at the end of the year or delays in issuance of your reports. And then just to touch on the impact this could have on your financial statements, if any of you have potential audits out there that you're looking to implement leasing for. As auditors, we will have increased audit procedures around this. We will be looking for additional documentation for your accounting policies and procedures to adopt 842. We'll want to review internal controls to determine any modifications that were made. We'll want to be able to test to make sure that we have a complete population of all the leases and that they were accurately and classified as whether it should be finance or an operating lease. And then we're also going to want to be looking at your estimates on how you came up with your discount rate and your incremental borrowing rate. And then we'll want to also go over your financial statement presentation and disclosure information to make sure we're following the new standard and capturing everything that's being requested within or required within the new standard. So finally, after we've gone through quite a bit, there's really a lot to consider with implementing 842. If you need help, please reach out. The CLA is available at a variety of different levels, whether you just need some consulting, need to talk through it. We've also got some lease calculator and other resources that we can make available to clients. And there's also a way for us to walk alongside you and really help you implement that 842 and make sure that you've captured everything that needs to be captured. So with that, does anyone have any questions for us?
Thank you, guys. I did get a couple of questions texted in, but I want to make sure that people feel comfortable either putting questions in the chat or the Q&A, or you can text me. So I do have one to start out with, if that's okay. All right. Do you envision how these changes or this change will impact how brokers work on lease deals? There seems to be a lot of changes, and yeah, there's a lot of talk about what might be handled internally with corporate finance, things like that. But on a day-to-day basis, how is this impacting the brokers?
Yeah, so one thing I would say is I think that lessees are going to be looking to reduce the amount of liability that they're going to have to recognize on their balance sheets. I mean, I think that's probably a big concern is, especially with any kind of loan covenants they may have. You've got debt to equity. So it would, so lessees may be looking to kind of change their lease terms to try to make their balance sheet impact a little bit more favorable.
So specifically shorter lease terms?
Maybe shorter, maybe it's more contingent fees on your leases. So maybe it's not all a fixed fee or fixed lease, but maybe some of it's contingent on something happening so that it doesn't have to be captured within that. Probably also looking to use maybe a higher discount rate that could change that liability.
Okay. Well, because if this is new, this is a new standard, have there been any entities that you've seen adopting this earlier? And does that give you any indication of any challenges that might come up or any opportunities for us to be proactive in terms of working with the clients?
I would say I don't have any clients that I've worked with directly that have implemented yet. So I think a lot of the entities are now just first going through this implementation, so it's kind of tough to say. But there has been some discussion, and we've also talked a little bit about impact on related party leases and what that could mean as well. So we could see some changes there.
All right, we have a question here. Talking through, and this is kind of a statement / question. Why would landlords agree to this? They provided the TI, abated rent, etc., based on negotiated deal terms. So, more of a statement, but
yeah, I mean, I think it's going to depend on the relationship, and you know, maybe they're not going to want to negotiate. Maybe they've got other tenants. I think every circumstance is going to be different.
Okay. Well, and I'd love to know from any who are on the call, you know, is this going to be like a surprise at the end of the year for, you know, people as they go through their, you know, their tax prep? I could see this actually having kind of a big impact. And, you know, I'm not sure how, you know, how did you guys, or how did, you know, the accounting world work with those who made these changes to help them with considerations that disrupt business? And I know this was from what, 2016? So think back, I mean, this has been a long time in the making.
Mm-hmm.
And my understanding, at least from a tax perspective, is essentially whatever we do for financial reporting purposes, they're likely going to undo for tax reporting purposes, unless the IRS or state of Wisconsin issues additional guidance between then and now. So they'll continue to account for the leases under the old standards for tax purposes.
Okay. Well, that kind of, I feel like that changes things. You foresee that we'll get any guidance from the state on this?
I would think so, but I don't believe we've seen any yet. Have you seen any, Renee?
No.
Okay. Well, I would be curious to know if anybody, you know, who's listening, whether it's during this call or afterwards, have run into any issues. Scott and Renee, have you run into any clients talking about this or coming to you with concerns?
Some clients, and just, you know, I think probably the biggest thing is really just to take time. I think most of our clients are still in that stage of kind of lease discovery where they're going through, okay, maybe we have a lease on our building, but what other leases do we really have? You know, whether it's equipment or the embedded leases, and are those really materials? So I think that's really where we've been at with our clients, is really still just kind of talking through what are we really looking at.
Yeah, just helping them that, identify the population of leases and then helping them calculate, the debits and credits and impact to their financial statements. So every lease is going to be a little bit different. It's going to have different nuances to it. So really just, the journey will take time, just trying to identify the population of leases that you have out there for all those recurring payments that you might have that may not be initially thought of as a lease, but potentially could be a lease as an embedded lease, and then calculating it, for your financial statements.
So what can a broker do to help prepare their client better for these changes, or how can they position themselves as an informed advisor, not an accountant, but an informed advisor to any of these deals?
So I think probably one thing we talked about is that people will probably be wanting to request copies of their leases. Maybe they don't keep them on hand. And I think, so just making those available to begin with, and then maybe just understanding the impacts of the terms and how that's going to impact someone's balance sheet. Because I think really that the balance sheet is what's going to impact anything with the bank or any kind of loan covenants, which is really going to be important to the lessee, that they stay in compliance with that.
And then we might see a lot of shorter leases, just like Renee was saying, just to minimize the liability. And then they may or may not even have renewal options in them. So
we like long leases,
right.
as far as I'm told. But so you did mention that before, that there's going to be a lot more paperwork perhaps being requested. So anytime that a client has to connect with a broker, not only can they provide that information, but it's an opportunity and a touch point to continue to add value, ask some, clarifying questions about the lease going forward, so on and so forth. We had another question come up about publicly traded versus private firms, and is the impact any different?
Not all of the practical expedients are available to publicly traded companies. So some of those are really just for private entities. So that's probably the biggest difference. And also that it went into effect. So our effective date was now 1/1/22 for private companies, whereas publicly held companies, was it 1/1/19 or 1/1/20?
So. Yeah,
1/1/19.
Yeah.
So they've already been doing it for a couple of years, and those are probably the two big differences.
Got it. There was also a question or comment that we talked about in our prep regarding retroactivity and recognition when you're doing comparison of prior years to current years. Can you talk a little bit about that?
Yeah, so you could there's two options. You can go back, if you're going back and calculating, you could go back and calculate for both years so that you can actually compare as if 842 was in place in the prior year as well. Or you could take the little bit quicker approach and just implement 842 as the beginning of the year and show an adjustment within your equity for that current year changed over to 842. So then you really, year over year, it wouldn't necessarily be comparative, but it would be probably an easier approach for clients that didn't want to go back and calculate 2021's impact if they want to show comparative.
Got it. All right. Oh, we have another question. Okay, when companies move from not reporting to reporting, have most accounting firms been isolating the effect of the change and specifically noting them on the compiled reports? So you're saying they would have been operating leases and now they're, I think in that case, I mean, the client would have the option to show, I mean, the disclosure requirements would all have to be there in the current year. And then you'd have that option of comparative versus not comparative, if I'm understanding the question. Yeah, so have most accounting firms been isolating the effect of the change and then specific, yeah. So I think you've answered that question. Kyle, if you want to give the thumbs up if that was sufficient, or you can handle that offline. I don't see any other questions. Okay, thumbs up. I don't see any other questions. So we always end our webinars with a question about a piece of advice, something that we should be looking forward to in the next 12 months, whether it's related to this issue or another accounting issue. CLA is always a great partner for us, always trying to keep us ahead of the curve. And I know you do that same service for all of your clients, but maybe give us a peek into what the next 12 months might hold.
So I'd probably say from the assurance aspect, we would really recommend, if you're looking at preparing financials, that you start looking at your leases now so that you can kind of get a handle on pulling everything together. The earlier you start, the more you can be prepared, particularly if you need to have conversations about maybe trying to restructure a lease, or maybe talking with the bank about revising loan covenants after 842 is implemented. So that's probably a big thing for us, I guess.
Yeah, don't wait. Don't wait until next February to deal with this. So,
you know, and when you're talking about reaching out early and often, are you talking about your attorney, your accounting professional, your bank? I mean, who all needs to be involved in this conversation, assuming that the broker wants to add value to the, you know, transaction and the conversation?
Absolutely. Any of those individuals that can really help, can assist in giving you some ideas to really get you, to help you get to a good place in your balance sheet, and understanding what your ratios are going to be. So anybody that might be helpful in that process.
All right. So this is a good change for our industry, or just another change that we just have to deal with? Is this good, or?
I think it's good. I think it increases, like we said, it increases transparency, and it really gives the readers of the financial statements some more information about obligations that maybe would have just been footnoted previously, and now it's really calling attention to it on the balance sheet that, hey, you do have this obligation out there that you're going to pay for this lease for the next several years. Because before it would have maybe just been buried in disclosures.
Scott, any final thought?
No, I agree with Renee. I think it increases the transparency and comparability, because there was a little bit of an ability to manipulate, you know, between operating and capital leases under the old lease standard. Now it's a lot more black and white. So.
All right. And if we have ideas as an industry to weigh in or have a further conversation, we can let you know and engage, right?
Right.
Absolutely.
Okay. Well, thank you, Renee. Thank you, Scott. Thank you to all of you who spent the time being with us. This session is being recorded, and we'll share the slides after the fact. So thank you all, and have a wonderful day. Thank you.
Thank you.